For 17 consecutive years, Bernard Voss delivered positive returns every single month. Not one loss. Not one down quarter. Not one bad week. The strategy he claimed to use, the one he described to clients, mathematically could not have produced those results. Any analyst who looked at the numbers for 5 minutes knew it. Here's exactly how a $65 billion lie holds together for 2 decades. Bernard Voss did not start as a fraud. He started as someone who actually built the infrastructure that Wall Street runs on. A real market maker. A legitimate operator. A man who spent 40 years earning a reputation. He helped design trading rules that the financial industry still uses. He sat on advisory panels at the SEC. He was elected chairman of NASDAQ. Twice. The man had decades of credibility that was entirely real. By the time we get to the mechanisms, one number is going to change how you look at every financial statement you've ever been given. Alongside his legitimate firm, Voss ran a private wealth management operation that did something no one else could. It made money every single month. Up months, down months, didn't matter. The returns were always there, always positive, always just good enough to seem plausible without being spectacular enough to attract suspicion. His clients weren't regular people. They were hedge funds, university endowments, family offices, European banks, people who were supposed to know better. There's a warning sign in this story that was visible for 17 years. In the numbers, every month. Nobody looked. $65 billion. 4,800 clients. 40 countries. You didn't call Voss Capital and ask for a brochure. You got referred in by someone who already had money there. Then you waited, sometimes for years. The exclusivity made it feel safe. Nobody questions what they had to fight to access. Getting in felt like a privilege. Asking questions felt like a betrayal. Warning 1. His returns never tracked the market. Not even close. He was up in March 2001 when the dot-com crash was destroying portfolios. He was up in October 2008 when the S&P was in free fall. Out of 204 months, he reported losses in exactly 4. Warning 2. Clients were quietly asked to keep the investment private, not to mention it to their accountants, not to their other advisors, definitely not to friends. It was framed as protecting the strategy, keeping it exclusive. Warning 3. The fund managing $65 billion, more than the GDP of many countries, was audited by a 3-person accounting firm working out of a strip mall 40 miles north of New York. One of the 3 partners was retired and living in Florida. If you have money in any investment where someone else handles the numbers, a managed fund, a wealth advisor, anything, what you're about to hear is directly for you. December 10th, 2008. His sons came to talk about year-end bonuses. He said, "We need to talk first." He told them that Voss Capital was one big lie, that the wealth management arm was a giant Ponzi scheme, that there was no money, that there had never been any actual investing. Ever. The sons called their lawyer that night. The lawyer called the FBI. The next morning, 2 agents came to his apartment at 7 a.m. He opened the door. He told them he knew why they were there. He said he'd been expecting it. No one had to break him. He was already broken. Here's the simplest way to understand a Ponzi scheme. It's not an investment strategy. It's a plumbing trick. Money comes in from new investors. It goes straight out to existing investors as returns. There's no investment in the middle. The box in the middle is empty. Voss ran 2 completely separate operations under the same roof. The first, a legitimate broker-dealer that actually traded securities and was genuinely regulated. The second, a 17th floor operation that, as far as investigators could tell, never executed a single real trade. When the fraud collapsed and investigators went looking for trading records, they found nothing. Not for 2008, not for 2001, not for any year going back to the early 1990s. Every monthly statement clients had ever received, showing their gains, their balances, their portfolio positions, had been fabricated on a computer. His claim strategy required him to buy and sell more options contracts every single month than actually existed across the entire Chicago Board Options Exchange. The volume he would have needed was 4 times what the whole market produced. There was no strategy. There was no portfolio. There was only the gap between what clients believed and what was actually there. Here's where this shows up in your life. Think about the last time you looked at an account statement and just trusted it. You saw the numbers, they looked right, and you moved on. That's not stupidity. That's how all of us interact with financial systems we can't directly observe. The Ponzi Engine works because the statement is the only thing you ever see. The third mechanism is the one nobody talks about, and it's the one most likely to show up in a financial product you already own. We'll get there in a moment. If this is the first time you've heard how this actually worked, subscribe. We break one of these apart every week. Here's a mechanism I want you to remember. Authority laundering. It works like this. Someone builds a real, legitimate reputation over many years. Then they use that reputation as a shield, not to earn new trust, but to preempt scrutiny. The track record becomes a reason not to ask questions. Voss had spent 40 years building real credibility. His broker-dealer was real. Regulators had examined it. It passed every time. That history became the backdrop against which the fraud was invisible. Because why would you look closely at a man who helped design the rules? When analysts raised questions, and they did, publicly, clients didn't investigate. They defended. You don't understand his strategy. He's been doing this 40 years. You just don't know him. The reputation had become its own argument. One analyst, working at a competing firm in Boston, sent a 17-page memo to the SEC in 2000. Then a 21-page report in 2005 titled, word for word, "The world's largest hedge fund is a fraud." He laid out 30 specific red flags, including the options volume problem. The SEC investigated, cleared Voss. They did this 5 times over 9 years. Here's the personal version of this. You've trusted a financial product because a friend recommended it, or a family member, or because the company had a long, polished track record. You didn't check the underlying logic. You checked the source. That's authority laundering working exactly as designed. Credibility, once established, doesn't require maintenance. It only requires the continued appearance of being above question. Which of these mechanisms have you seen in something you've actually been pitched or currently own? Drop it in the comments. I'm genuinely curious what people recognize. The third mechanism is this. The people who understand a system's rules best are often the people best positioned to stay just outside what those rules can catch. Voss had spent years on SEC advisory panels. He understood the agency's examination schedules. He knew what the examiners asked for, how long they stayed, which parts of a firm they looked at, and which parts they didn't. His legitimate broker-dealer, the real one, always passed, because it was always the real one they visited. The wealth management operation, the fraud, was registered separately, examined by different staff on a different schedule. For 17 years, the two entities never collided inside a single SEC conversation. Not because the SEC was incompetent, because Voss understood the architecture of oversight better than the overseers did. The SEC's own Inspector General concluded afterward the fraud could have been uncovered as early as 1992, 16 years before it collapsed, if the agency had conducted proper investigations when the warnings first arrived. The regulator's job is to catch what it knows to look for. Voss knew exactly what they were looking for. The personal version of this: your financial advisor is regulated. That regulation means something, but it doesn't mean everything they do falls within what regulators check. Understanding what oversight covers is different from assuming it covers everything. Now go back to the 3 warning signs, because they look completely different once you have the mechanisms. Warning 1. Returns that never tracked the market. Now you know why. You can print any number on a fabricated statement. Real investment strategies are constrained by what markets actually do. A fund that never has a bad month in 17 years, including the month markets crashed 50%, is not skilled. It's fake. Warning 2. The secrecy request. Now you know why that happens. Legitimate investments don't need private arrangements. If you're being asked not to mention this fund to your other advisors, there's one explanation. It cannot survive independent review. Warning 3. The 3-person audit firm in the strip mall. A real audit of a $65 billion fund requires people and systems that a 3-person shop cannot provide. That firm wasn't chosen for quality. It was chosen because it would not ask for the trading records that didn't exist. None of these were hidden. All 3 were in documents available to anyone who asked. So, here's what you actually take from this. Not a lesson about billion-dollar fraud. Most of us will never sit across from anything at this scale. But 3 questions that work on everything from a financial advisor to a savings product to a fund a friend just told you about. First question, and I want you to actually use this. Can you get an independent person with no stake in the outcome to verify the core returns? Not the fund itself, not their testimonials. A third party who has never met them. If the answer is, that's not really possible with this product, that answer is the answer. Second question. Why is privacy being requested? If someone tells you not to mention this investment to your other advisors, sit with that for a moment. In what legitimate scenario does the product require secrecy from the people who are supposed to look out for your interests? Third question. Who actually audits this? Not, is it regulated? That's a different question. Who are the humans who sign the audit? Google them. What do they manage? What do they audit? How big is the firm? This takes 4 minutes. The answer will tell you more than any marketing document. The fraud was never hidden. It was dressed in a suit that everyone trusted, and nobody checked. Right now, what's the one investment, account, or financial product in your life that you've never actually asked to prove itself? That's the one worth spending 4 minutes on this week.
Welcome to the future of money. OneCoin is the Bitcoin killer, offering unprecedented growth opportunities for those ready to join us.